Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look at our latest trade from earlier today, a bearish call credit spread on the semiconductor ETF SMH. We're an overbought, overvalued, and overinflated IV set up ideally for a call spread with edge. As we always like to do, we take that fusion approach where we take a look at the fundamental, technical, and probably most importantly, IV analysis to find the edge and put on the head. So let's jump in and take a look. First of all, here are the components of the SMH, the semiconductor ETF. You can see NVIDIA by far the biggest holding, but you have Taiwan Semi at almost 10%. Micron now, because of the massive rally at over 8%. Broadcom, which reports after the close today, at over 7%. AMD also with a massive rally at 7%. So these top holdings, right, comprise almost 50% of the ETF. So it's impossible really to get a great handle on the valuations of an ETF because of the components, but you can drill down on the top holdings. So it did just that. So here is the simple price to earnings chart over the beginning of the year till now. You can see Micron, one of the top holdings, trading at over 50 times PE. That's after earnings are factored in. Earnings, no doubt, were great, right? But you can see valuations continue to go sky high. NVIDIA, the biggest holding, right? Actually, probably the most value here, right? Although that's even come off the lows, certainly from early May here. So NVIDIA looking comparatively cheap. You can see Taiwan Semi now hitting over 30 times PE for basically the first time this year. Broadcom over 90 times. You can see a huge run up in the PE ratio. AMD just to the moon. So certainly the valuation multiple is getting stretched. Price of sales reflecting a very similar thing. So from a valuation perspective, from the fundamental side, certainly the semi stocks getting a little bit rich, to say the least. We also like to take a look at the technicals. Here's a chart on the SMH, and you can see certainly getting overbought, but it has been for a while. You can see 9-day RSI still over 80, right? So that has signaled overbought, and it's starting to at least soften a little bit. Bollinger percent B, which is implied volatility based, still over 100, so that is absolutely stretched as well. Again, an overbought indicator. You can see implied volatility. We'll take a deeper look in a second. Basically, you hit the highest level of the year, starting to just soften a little. I kind of like waiting for things to soften to show a little bit of give back here, like the 9-day RSI, Bollinger percent B, IV, right? And you can see MACD has been basically trudging around the kind of unchanged level. So, if you will, the magnitude of the rally starting to slow here. The shares trading at a still big premium to that 20-day moving average, which it has not been below, right, since this massive rally started all the way back basically at the end of March, beginning of April. So we have been going on over 2 months where it's been the straight up sort of move here. So I'm really not looking for necessarily a big pullback or even a pullback at all, but just a slowdown in the rally by using these extremes to structure a call credit spread. We'll take a look at which one in a second here, but you can see shares certainly getting stretched on the technical basis. 9-day RSI still over 80, right? Bollinger percent B still over 100, shares at a huge premium still to the 20-day moving average, which it hasn't been below in over 2 months here. And MACD, which is a good way to look at kind of the power of the rally, starting to slow down a little bit. So I think an opportune time to take advantage of an overvalued and overbought SMH. I also did a comparative versus the NASDAQ 100, the triple Qs. NVIDIA, the biggest component of each, right? So normally they're fairly correlated. Here's a 2-year chart, right? So going back 2 years, you can see in blue is the triple Qs, in black is the SMH. Have been pretty highly correlated, right? Anytime the SMH got out over the skis a little bit, it reverted back. In fact, the last time was in kind of late February, right before the kind of made that low before the latest rip-roaring rally, right? It got to a 40% two-year outperformance versus the triple Qs, but as you can see here, then became the big underperformer. Now we're looking at that outperformance at over 95%, and all of it basically since we saw on that chart that low in the end of March, right? Shares have been up almost 100%, right? The Qs have had a heck of a nice rally too, but the semis absolutely rip-roaring red hot here. I think a little bit too much. So a period of cooling off, I think, is in the cards here, especially now that earnings are pretty much done, right? We do have Broadcom after the close today, so we'll see how that one fares. And then one of the biggest components I like on this is implied volatility. You can see IV, I used a 30-day IV at the highest level of the past year, but starting to weaken a little bit. That's the theme, right? Starting to weaken. You can see IV, especially on the short end from, Tuesday to Wednesday, did finally drop a little bit here. So that gave us a signal to jump in, and we'll take a look at that spread in a second. You can see here's a different look at implied volatility from May 6th to June 3rd, right? You can see over the past month, basically, implied volatility has rocketed from under 43 to briefly over 50 yesterday. Today, finally dropped back below, but still at very rich levels. Took a look at a one-year chart on a basically 25 delta 30-day call. You can see that huge jump in IV, right? And again, reaching the highest level by far we have seen over the past year, but starting to weaken a little bit. What does IV do? It means you can get further out of the money for the same net credit, or get a bigger net credit for the same distance out of the money, or what we like to do, kind of combine the two, right? Get a little bit bigger credit, a little bit bigger cushion. So that was a trade we did today, basically on the opening, right? We saw the SMH slowing down and we jumped in and took advantage of it. So we sold the June 18th, right, expires June 18th, so 2 weeks from this Friday, 700 call, bought the 702.50 call, right, received 45 cents net credit, right, on the trade. You can see the IV that we sold it at, well over a 50 IV. The SMH was basically right around 640 at the time. So as we said, 15 days to expiration on the trade, 60 points of upside cushion, right, or almost 10%. So we can still have the SMH go up an additional 10% from where it is now, right? Even after this rip-roaring rally, we're up at this level here before we get in any sort of trouble at all, and we do have defined risk on the trade. We also can sell some shorter-term put spreads against it if need be to hedge it off, or for those who are probably a little bit more neutral, you may want to take advantage of this high IV, right, and sell an iron condor trade. So our max gain on the trade, 45 bucks. That's the credit we received on the trade. Max risk is simply $250, right? 2.5 point wide spread, 250 per spread, less the 45 bucks received. So the most you can lose is 205 bucks, or well over a 20% return on risk for a trade that expires in 15 trading days, that has a 10% upside cushion on an overbought, overvalued, and overinflated from an option price side, as we said, right? You can see the overinflation here. We look for that to temper. That'll be a benefit to the trade. Technicals, we look for this comparative performance gap to close, certainly, right? Shares getting extended and have been for a while here on, technical basis. As we said, the valuation multiples is getting stretched, no doubt about it. But as we always like to say, trading is all about probability, not certainty, right? So make sure you position size accordingly. Make sure you get out if it becomes troublesome for you. But at the end of the day, right, you sometimes just got to say WTF, right, from the great movie Risky Business, because we know this will end badly whenever you see these sort of components co-align. So until next time, as always, here's the good